I was actually saying to Father Sicard and the provost, this reminds me of when I was in high school. I was going to have a party for just a few people at my house, and then the whole school showed up. And that's some of our Zoom friends. So they put this deposits and they put it largely into bonds, and they had that cushion. Okay, so what happened in 2020, 2021, and early 2022? Interest rates were very low. Silicon Valley had bought a bunch of bonds that paid about an interest rate of about 1.5%. Okay, now that's okay if rates don't change, or if you never need the money and you just hold it to maturity. Well, what started to happen in 2021 and 22? Inflation started to move up. Okay, this was the post-pandemic response. A lot of economic activity. We had supply disruptions. Was it transitory? Was it not? Doesn't really matter. It was. I mean, it existed. And so what happened with that? What happened with that is the Federal Reserve started taking their target rate from 0.25, actually even lower than 0, 0.25 to half a point, and it crept up. Today, that number is 5.25, 5.5. Unprecedented increase in federal funds rate. So rates go up, and with that, that created some noise for people who owned a lot of bonds and other assets. We all know this, but this makes me feel like I'm, in a finance discussion. When interest rates go up, what do bond prices do? Will? Head of the class, we'll call Sante. And typically, if interest rates go down, bond prices go up. We were in a period on the right. Interest rates are going up meaningfully, and bond prices were going down. This is a noisy chart, but this is the yield curve. And if you look at it, it's the green down here, kind of the right, is it kind of 21. The other number kind of in the middle is 22. And then when Silicon Valley started having its issues, that red line, that was the yield curve in March of 22, or March 23, excuse me, I got my finger. And you look at that number spiked, and it really spiked on the front part of the curve. That's interesting, but because of bond math and the sensitivity of bonds to changes in rates, if you owned a lot of long dated securities, you were more subject to price moves, and we'll go through that. So when did this all start to go? So if you were at Silicon Valley Bank, you knew you had a lot of deposits, you knew you had a lot of bonds, and you knew you were probably not doing great on your bonds, but you were fine. And you're kind of, one of the things we talk about is the strategy here was probably hope, right? You were hoping that rates would stop going up. But during that first couple months of 2023, rates were going up, and they experienced a lot of, losses on their balance sheet. So the two things they did that really triggered this, and then we'll get into our panel discussion, is they did a strategic update for investors. And they said that they had sold about 26 billion of bonds, and they took $1.8 billion after-tax charge. Okay, well, there's a couple of things. After-tax charge means the loss was actually bigger. They lost about $2.5 billion on their portfolio of 25. So it was about 10 cents on the dollar. Like, okay, that's a lot. And at the same time, they said, oh, we lost $1.8 billion after taxes, 2.5 before. We need to go out and raise some dough. Not great. Silicon Valley Bank races to prevent a bank run as funds advise pulling it because they had a lot of venture capitalist companies. Venture capital firms pretty concentrated. They have a big portfolio of companies, but you can have 10, 12, 15 people make a lot of calls, and you can have a pretty big run on the bank. And that's what happened here. And then Silicon Valley, and this is just context, how big the move was. $15 billion market value wiped out. By the way, just so you know, that was about equal to the $16 billion book value of equity. And then on Friday, it got shut down. They had $42 billion of outflows on Thursday. They were set to have a significantly larger amount on Friday, and the bank was seized. Okay, and then you see the headlines: Silicon Valley Bank fails after run on deposits. There's a lot of name calling, and we can have a discussion about that. But this ended up being the biggest failure. 48 hours, 200 billion of assets, 15 billion of market cap. At one point was significantly higher than that. It was gone. And with that, we're going to get into our panel discussion. Unless before we do that, Tom or Sylvia, you want to throw anything in?
Well, if you go back to the picture of the CEO,
No,
the other way.
going, still going. Here we go.
Yeah.
Sorry. This happens at home with remote too.
At home, I'm not permitted to hold. Right, so you've got Greg Becker, who for 20 years is held to be the smartest man in banking. He has a franchise which controls all of the technology companies, small technology companies that want to A, raise money with the venture capital firms, or B, go public. If you haven't gone through Silicon Valley's underwriting and review of a small company which is going to go public, and these guys are absolutely brilliant at picking winners from losers and telling management what management is supposed to do to be successful, and then lining them up with venture capitalists. And the deal was, once you were a client of Silicon Valley, and you raised money, so round 2 of a small venture firm, right? You raise $1 billion, you raise $100 million. Well, that $100 million is cash, right? It goes to you, right? And you're going to spend it developing your product, your client base, your earnings, and the rest of it. Well, where does it sit? Well, it sits in Silicon Valley Bank in a non-interest bearing account. And so how successful were they? Well, they were so successful in raising all of these things is they raised more money in deposits than they could make in loans. And so if you take a look at their balance sheet is upside down, right? The amount of money you want to invest in securities, especially highly rated securities, you're required by the Fed to have, 12% of your assets, right? That's about right. 12% of your assets in something which can be liquidated in case you have some sort of a run on your assets. Well, that's upside down here. I mean, you've got all your money in liquid securities and none of your money in loans, because the business model is not built to generate loans. It's built to generate fees, and it's built to generate deposits. And in fact, these guys are really interesting. We, when I was at SunTrust, we opened an investment banking office in San Francisco so that we could be close to the guys at Silicon Valley Bank, so we could be the first participant in their loans and catch some of the excess deposits, potentially. But certainly catch some of the fees that they were making with this stuff.
So, and there is some debate in the press about whether this was a bank failure or a tech failure, right? So what happens is when the venture capital and private equity world in San Francisco around tech starts to shut down, there is no longer a steady flow of these zero interest bearing deposits. And to make matters worse, because these companies aren't, these startups aren't getting further rounds of investment, they have to start pulling out cash to make payroll, because the wheel of progress in the tech sector, startup, and private equity world is grinding to a halt. So there were people at the time who said this wasn't a bank failure, this was a tech sector failure. So that's still, I guess, part of the topic we're talking about here, is in what ways was this a bank failure and not a tech failure?
To take a step back, so by the way, my son called me, so I have a college son, he's like, Dad, you're gonna speak in front of a bunch of people, you prepared questions, right? Like you're doing something here. So we do, you both been around banking from different things. So this all starts to happen. What's going on for people who are thinking about bank? What's going on inside of a bank? And I'm not talking about the day, but as this is starting to grind down and kind of the end is becoming maybe not obvious, but it's going. So Tom, you've been, and by the way, Tom's job was to keep his banks from having to answer this question. But what was going on, do you think, in terms of in Silicon Valley Bank? I don't mean the night before, but in that 3-4 months where they've got these losses from rates. How would you think about that?
I'd go back 8 or 9 months. And I'd go find the previous risk officer and find out why she resigned.
People aware of that little factoid? So the chief risk officer for Silicon Valley Bank announced her resignation, and then I think in February and left in April, and it was gone 11 months later, something like that.
Well, and they had no,
didn't have a chief risk officer.
they had no,
9 months prior to the failure.
nobody independent looking at what was going on. If I'm chairman of the risk committee, right, I'm livid by this time, right? And whoever was on the board will never sit on the board again. And management will never work in a financial institution. And you go back a year before, and this is the most brilliant group of people in banking. The most brilliant group of people in banking. So what's happening? You're looking for it. You're not really worried about it. The other thing is who runs banks, right? Who is generally the CEO of a bank? Well, generally the CEO of a bank is a commercial lender. That's where all the glory and all the,
They're the fighter pilots of commercial banks.
they're all the smooth guys and the smart guys. Problem is, I don't know anything about asset and liability management. And quite honestly, that's the giant failure of this institution. Because whoever's running it doesn't have any idea what's going on and how the balance sheet is constructed and what's going on in the balance sheet. And so, and they don't have a chief risk officer, right? Chief risk officer has got, I'll say, 4 major responsibilities, right? Credit, right? Because credit is the lifeblood of a financial institution, of a bank, right?
And that means understanding how much credit risk is in your portfolio, right? That's the credit person governs your underwriting process. Who are you making loans to? And what is the likelihood that you're not going to recover those loans?
Right. Your load grading process, which is a scale of how much risk is really within your portfolio, is governed by that same group of people. You have your market risk function, which is the independent group of people. Probably should have done this in different order, but an independent group of people that are testing all of the modeling activity of the balance sheet and what the value of the balance sheet is. And one of the tests we were talking about before we came, one of the tests that we did is we did a sensitivity test at least every month. And at least when there was any movement with significant movement within the balance sheet, we went 500 basis points up and 500 basis points down. And if they had done that, right, they never would have permitted 3/4 of their asset or 67% of their assets to be in securities on an unhedged basis.
So that's loans, that's market risk, liquidity risk?
Liquidity is part of market risk.
Okay.
You have compliance risk. And then you have what I would describe as
Compliance risk means you're not complying with all kinds of regulations, like there's a lot of regulation in place to protect consumers, for example. So
the primary regulations issued by the Federal Reserve and the Office of Control of the Currency are alphabetized, reg A, B, C, D. Well, there's 52 of them, and they stopped issuing those regulations because when it got to double C, it was too much, and they started reading. But so you've got capital adequacy, which is really the province of the regulatory authorities and the chief financial officer. You really have asset quality. You really have liquidity and market risk. You really have compliance risk. And then you have all of those other reputational risk activities. And then the fifth one is operational risk. How does the bank run? Does it meet its requirements, its obligations? can it in fact process all the transactions it gets done? And do you have the appropriate technology? That's kind of the province of the chief risk officer. And the chief risk officer in most institutions does not report to the CEO. He reports directly to the risk committee of the board, so there's an independent oversight and review. And I will tell you, the CEOs hate that.
You can imagine this is like going back to Maverick and Top Gun. You know, he wants to fly below the flight deck or above the flight deck, and the chief risk officer is saying, no. You got to keep it within these boundaries. And I know you don't like it, but there's a reason for it.
Yeah. Well, the fun thing about the boundaries that you set is you go back to the businesses and tell me what boundaries you're going to operate in. Tell me how you're going to run your business. Tell me what it looks like. And from that, you let them define their own boundaries, and then you test them constantly. And every time they step out of the boundaries, you step in and say you have to go back in, or you have to go to the board for variance. And nobody wants to go see the board and say, we were just kidding about how much liquidity we needed to hold or something like that. So here, there was this giant failure of, they lost their risk discipline because the chief risk officer left, and they didn't replace her for a year. Did they in fact understand their balance sheet, its composition, and how it was supposed to operate? Because early in this saga, you could have hedged your risk. It would have cost you $100 million. But the bank would be alive and operating today. Because I'll give you the other interesting thing from my point of view, right? Is the Fed told you what they were going to do. They told you a year ahead of time what they were going to do. And these guys were totally tone deaf, right? And the little chart about bond economics, right? Arrow up, arrow down, right? I don't think they understood that.
I think it's really interesting, and we've got a long deck by this, I won't do it. But when you go to their financial statements, you can actually see a $15.1 billion unrealized loss on page 56 or whatever it is. And they tell you that the 91 billion of securities we're holding has an unrealized loss of just about equal to our equity cushion. And what I think is really interesting, and then I'll kick it back to you, at some point, they said, okay, we have a problem. They went out to the market, because one of the things that happened, companies disclose on the end of the quarter, the 31st of December, it kept getting worse for Silicon Valley Bank in January and February. So all of a sudden, the fire just got too hot. They had to go to market. And Tom, we were having this conversation, so I'll get back to you. So they needed capital. So how, and we've talked about this. How did they go about it, Tom? Because this is fascinating. This kind of was the nail in the proverbial coffin.
Well, they went to Goldman Sachs and asked for advisory services and the rest of it. But in the middle of trying to raise the funds, the rating agencies told them that the next day they're going to do a downgrade. This was not the CEO going out and saying, look, I had a little problem, let's not worry about it. It was the next day their bond rating was going to be downgraded. So you had a triggering event where they had no choice. And so either Goldman was too slow, which I don't believe. These guys were way too late. They when they had wiped out their entire equity position with their bond portfolio, that's a little late. I mean, they should have been on this when a couple of $100 million, right, would have solved the problem, because they could find a couple $100 million.
So we're going to mix it up again. So when I sat down with the risk management group, oh, by the way, deserve a lot of credit because they kind of spent a lot of time. So
This is a really good deck if you to go through.
That's Abby and Brendan and David and Chris and Kieran. But one of the things they asked a question, if you go back to 2023 and 22, there's a lot of different risk issues happen. So first you had the British gilt market kind of imploded, not a dissimilar issue. Along the way, you had Sam Bankman-Fried and FTX. You had a range of issues related to crypto. You had our own kind of banking tempest. So one of the conversations we got into is risk getting more complicated? Were we getting worse at it or both? So Sylvia, I'll give you first crack at this one, and then Tom will go over you on that one.
So, I mean, what a layup question. Obviously, risk is getting more complicated when you think about cybersecurity. So, banks don't function well these days if they don't have, an online portal, right? I'm sure most of you are banking on your phones. So that risk is absolutely huge, and the regulators pay a lot of attention to IT security. So maybe we're overboard, but I just am puzzled about how this could happen, given the practices of the board that I sit on.
It's interesting.
And our bank is 12 billion. Our bank is just over the line where you get regulatory scrutiny. It's a bad place to be as a bank, actually, to have all of that regulatory oversight. And one of the pieces of this is the fact that banks of a certain size face more or less scrutiny. And the regulators have said they were asleep at the switch in this case, which is another kind of remarkable piece of this story. They've literally come out and said, we didn't do our job as we should have, right?
Well, they did, but that was the fourth group of the people who were responsible. The first group was management, according to the regulators. The second was the board. The third was Congress. And the fourth was, we might not have done our job as well as we should have.
It's interesting, Tom, when you talk about, in a way, the board should have been on notice that the water was getting choppier.
Yep.
And interestingly enough, during that period, the chief risk officer leaves. So you're in choppier water that should have been identified by the board, and then they kind of and we're fine without having somebody to help on that. Which, if you just kind of put the fact pattern together, is really unfortunate if you're that board.
Yeah, I think the other thing is how invested in the bank are the senior officers, right? I mean, can you afford a, where the price of the stock was? Can you afford a $10 dip in the stock price because you're going to say we're taking extraordinary steps to make sure that our securities portfolio is hedged and that the bank will always be safe? And the answer is, I wasn't there. I didn't attend the meetings. They had to have told me this. This is so incredibly obvious as being a problem.
Well, and so what Tom's
But the
talking
bank
about,
doesn't fail, by the way, because of the mark to market. Remember, we talk about what's their real equity, what's going on here. But the way the accounting works is you have two bond portfolios. You have the assets held for sale, right? And those are marked daily. Right, so all of the bonds and everything you've got in those portfolios, every day you mark those bonds. And then you have the held to maturity portfolio, which you don't mark, which are held at initial investment price. All you have to do is live long enough to get through the maturity portfolio, and you get all of your money back.
and what Tom's talking about specifically, and just kind of play that out. So the management team in theory had a choice. Hey, the bond portfolio is getting away from us. Let's take a charge. Let's announce that we're spending $100 million to go 200 million to go hedge the bond portfolio. And
18 months early.
yeah, you gotta do it earlier. You can't do it the day before.
Yeah, you can't do it 3 months before you
Yeah.
get taken over.
And that's that decision that somebody said, hey, along the way, I will get the stuff. Along the way, we got one more, maybe. We've got a tricky clicker. Anyway, that the stock would go down. And the issue is ultimately the stock went from 200 to 0. That's a really big move. But at some point, somebody's saying we don't want to, and by the way, the scrutiny that goes with that. That would be an embarrassing issue for management and things like that.
Well,
So
the
that's
first thing you do is you pick up the phone and you call your regulator. Right, and they would then come with a very large group of people to figure out what it was actually going on.
Well, that would make your life miserable. So your stock goes
It's not a
down.
fun thing.
Yeah, so your regulators don't love that. Talk about risk, because one of the things, and this goes back to Abby's point about the title risk management's a tough one to sell. But there's great jobs in risk, there's great opportunities in risk. So Tom, this would be more to you. Are there types? So, so the question we had, does risk management pick you, or do you pick risk as people are thinking about this? Like, I don't think you sat here in 1973 and said, I'm gonna go make a career in risk.
I was an econ major, right? I had, when I got out of, I graduated from here, I had applied to Boston College for their PhD program in economics. I had applied to my dream academic thing to the University of Hawaii for a PhD in international studies.
You gave that all up for Citigroup.
No, and then I applied to I went to Dartmouth to get an MBA. And so I did that and went to Citi and got about halfway through the training program and had a fight with the guy who was running the training unit, because I wrote a report about a company that was very, very clearly on the path to failure. It was a textile company. This is back in 1975. I heard your parents talk about that or something, but in 1975, I said the textile industry is failing in the United States. This company will fail within the next 10 years. We ought to start getting out of it now. The guy said, you have to change your conclusions in the report. And I said, tell me something factually wrong. He said, well, there's nothing factually wrong. I just can't have this floating around the files in case something bad happens. And 20 years later, this guy is my best friend. But I got kicked out of the training program and put into working out bad commercial real estate loans. So I spent 30 years doing commercial real estate lending. And just given the timing, I went through 7 downturns in commercial real estate. So I was a workout guy almost my whole career. I come to, I leave Citibank, I come and work at Fleet back in the day to rebuild their commercial real estate business. And then wind up running all the real estate businesses. And the guy who ran, who was the president of the company eventually, was a guy by the name of Bob Higgins. And Bob looked at me and said, we've got lots and lots of commercial lenders. We don't have many people as organized and blah, 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 blah. And if you knew me personally, you'd find that hysterical, because I can't, put things away or find them whatever I do. But move me over to risk management. That's how I got into risk management. And then when Fleet Boston got bought by Bank of America, I was cordially invited to find alternative employment and did consulting for 2 years with KPMG, which I hated. They pay you millions of dollars to come and give them advice, and then they ignore it and go back to doing what they were before. I said that was no way to spend your life. And then I got hired by SunTrust in January of 2006. And the world ended for financial institutions in July in 2007. And during that, really that 15-month period of time, we entirely repositioned the balance sheet of SunTrust, because it looked more like a savings and loan, meaning all they had were mortgage loans in one way or another. They had a $30 billion mortgage portfolio. They had $60 billion worth of mortgage-backed securities. And they had $20 billion worth of construction loans to home builders. That combination gives you death if, in fact, you have the downturn that happened in 2008, 2009.
So I'm gonna just jump in. You had a piece of a question about how unusual that this period of stress for banks was in the United States. And I I'm old, not sure which
Not as
one
old
of
as
us
me.
is older, but, I, for my, PhD thesis, I did a bunch of research on bank failures in Latin America with this mindset of, oh, I come from this very stable, growing economy, and oh, all these poor Latin American countries that, just can't keep their banking system stable. And so I did a lot of fascinating research on how the Mexicans, for example, bailed out their entire banking system in the 1980s. Never in a million years did I think that any of that would become useful in a policy manner in the United States. And so in 2007, I started getting phone calls from journalists going, what about that FACORCA program in Mexico in the 1980s? And so I'm literally going up into my attic, like pulling out these policy memos that I'd gotten a hold of that were written by Mexican central bankers. And so that was utterly shocking to somebody who had studied banking crises, that we would be in a position in 2007 to have to, pretty much bail out our entire banking system. And that eventually got me to Wall Street, where, because I had been close to some pretty epic bank failures, whenever the investment committee wanted to do a very, very risky investment, I was called the exotics girl. I'm not quite sure how I feel about that, but if it was an exotic investment, like
Remember, this is being taped.
yeah, like the one I most remember is to a semi-authoritarian government in a small Latin American country, and it was a several $100 million loan, 1-year loan, and I was the person who had to vouch for that, and I had actually had a lot of history in that country, and I vouched for it, and then things started going screwy in the markets in 1997, and I got a phone call saying, this is coming due in 6 weeks. Could you go and find out what the level of foreign currency reserves is in the central bank of that country? And I at that point, I said, wow, this is really, really what risk means when you're vouching for something, because somebody's going to call you up and say, go find out how much dollar reserves we guys have, and they pay back the loan. And my husband said, do you really want to be in this business? Because I think you've aged in 10 years in this 6-week time. So that's how I got into risk. It was really exhilarating, actually.
So the answer was, mine was pretty much accidental, right?
You were picked. Risk picked you.
You risk picked me.
And I picked risk.
Yeah,
Okay.
there you go.
So when we're sitting down with students about this, because one of the things for a lot of people in this room, financial services employs a lot of people, a lot of Providence alums, and somebody's like, is banking still a good business? And that's a profound issue. So I'm going to throw this out. This will be the open-ended existential question.
All right, so I'm going to answer it philosophically and then let Tom get real. So there is an argument to be made that plain vanilla banking is a public good. Again, we've got our economics major. A public good is something that you produce and you serve it up, and one person's consumption of it does not reduce another person's consumption of it, and you can't charge an individual consumer for it. That is a public good. What is the purpose of banking? It is to smooth consumption, smooth investment. So arguably, it is something that meets those criteria of a public good. It helps an economy work. The reason, somebody said to me, SVB's, it's over. We're having this conversation earlier this week. It just went away. Well, it went away because having learned from 2007, the US government stepped in, the taxpayers stepped in and said, we're insuring all of these deposits in an effort to stop a run. Why? Because the impact of a failing banking system hurts every single stakeholder in an economy. So arguably, you could say that there's a reason why we have credit unions and mutual funds. These are not publicly traded entities. These are mutual societies. And the history of that is precisely the history that recognizes that there are public good elements to a stable, what I'm calling plain vanilla banking system. Banking these days has become something very, 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 very different, right? The basic business of lending long and borrowing short and being involved in your community and underwriting credit because you know the business down the street. You don't make money doing that anymore. You should not be publicly traded if that's your basic business. So I think banking has today become a business that is far different from what we think of as, traditional banking. But anyway, that's my philosophical answer, and you can land it.
One interesting observation about Silicon Valley before we go back to banking. Right, the second largest bank failure ever. Why did the system not fail? The first was in the 3 banks that really got rescued. Everybody got paid. So the Fed said there's nothing so bad here we can't get. The second thing they did that they did not do in 2008 was make a market for federal government paper, both mortgage-backed paper and government papers, treasuries. And what caused the failure of 400 plus banks in 2008 and 2009 is they had very large securities portfolios they couldn't sell to anybody. And so anybody that was forced to sell created a mark for the entire industry. And we had paper, mortgage-backed paper, where I had information on every loan securing the paper, and I could value the paper to the penny. I couldn't sell it to anybody, but I knew what it was worth. And if the Fed had stepped in 2008 and made a market for that paper at above 85 cents, and generally that paper was worth 95 to 98 cents. At 85 cents, you would have had a fraction of the failures. And you had ethical concerns and why they didn't do it, why that stuff didn't happen. The really interesting thing about the Fed this time around is they learned from their mistakes and made sure it didn't get out of hand, for which the Federal Reserve should be congratulated in every conceivable way. They were absolutely brilliant in the management of what could have been a major crisis in the country. A. B, if you put up the yield curve picture.
I can do it. I have that technology now.
Yeah. Maybe.
It's gone.
Had it for a second.
It's kind of temperamental. Here we go.
So. Stand up just for a second.
Yeah.
I don't know about a pointer. I can stand up. Almost. As long as this exists, as long as short-term rates are less than long-term rates, there's a reason for the banking system to exist. You borrow short, you borrow cheap, you lend long more expensively, and you live in the middle. Now, what's happened, and why Sylvia, I believe, the good doctor, says is that much of the opportunity to do this has gotten away from the banking system as being done in non-traditional financial institutions. And that's because I believe the industry has become overregulated. But I'm a banker and I would always say it's being overregulated. Just a thought. But unless you get into those opportunities for either highly levered transactions or other types of transactions like that, can you live on the curve? And you can live on this curve. It's really hard to live on that curve. And so as long as you have too much intervention, and I'm sorry, our economist is still here, you have something called kind of new economics, which is central governments around the world are borrowing much more than they can afford to pay back. And the only thing that can happen is you inflate your way out of the problem. You borrow money today and you pay it back with really cheap dollars in the future, which is why you try to negotiate as low to a zero interest rates as you can when you borrow. Right? Does that make sense? It's probably too much, but you have to inflate in order to pay back all of the dollars you've borrowed. Very popular theory after 08, 09, and the rest of it is, how do you get enough money in the system to solve the problems? When you borrow it today, you borrow it for 0 interest rates and you pay it back, 20 years in the future when the dollar is worth half what it is worth today. That creates that yield curve. Way too much cash, way too much money, way too much liquidity in the system. It's got to go someplace, and it goes to the short end of the curve. And if you take a look at Silicon Valley Bank, they were a victim of that fiscal policy, because a lot of the money that floating around wound up in the hands of venture capitalists, the really smart people in the industry. They went into technology. Technology is where Silicon Valley, right? And you had a bank that trebled in size in 3 years.
With the same management team.
With the same management team, and that let some of the marginally important people, those would be the risk management people, but people that could speak in an independent voice lost their voice along the way somewhere. But yeah, I think there's an argument for banking. I think the fight is different. I think the fight is not with the small banks. I think the fight is, there are certain members of Congress and certain people with political leanings that believe is what we should have is a very, very large central bank, and it shouldn't be in the hands of private shareholders. And that's really the fight that's going on today. That fight is, go ahead.
The problem with regulation of banking and the reason that we have a lot of regulation of banking is precisely because banking has private goods qualities. Clearly have a point of view here, but regulation is backward looking. And smart graduates from Providence College that go into finance are looking for new ways to make money. That's how they're gonna get promoted and get their bonuses. So on the one hand, you've got smart graduates from Providence College who have done finance majors and double majors in accounting and econ, and they're looking forward, being creative and innovative, meeting the incentive structure that they operate in. And these regulators who are running around banks and banks, they live in the banks. I mean, the sort of frustration that you hear from Tom is very real.
We had 24 people.
Yeah, just
from the Federal Reserve sitting on the floor.
Sitting on your floor with you.
And wandering around talking.
But what they're doing is applying rules and regulations that are based on the last crisis that happened. So you've got a fundamental mismatch in the system. And I don't know that there's any way to solve it. Historically, before we had a central bank and before we had all these regulatory bodies, the banking system in the United States regulated itself. And, I often wonder if President Obama was thinking about 1897 when the banking system almost went down. And I think it was Morgan, I can't remember my history, who called all of his fellow bank leaders together in his library, bolted the door and said, you're not leaving until you cough up the money for us to stabilize this system and put an end to what was going to be a run that was going to put the banking system and the economy on its knees. That's self-regulation. And what President Obama did in 08 is he called the CEOs of all the major banks down to Washington, and he sort of tried to do the same thing. And I have friends who said, I didn't want to go, and I got told that if I didn't get on the plane and go, US Marshals were going to show up and make sure that I went. And why didn't they want to go? Because they didn't want the market to think that they were one of the banks that was in trouble. But the reason that President Obama was pulling everybody together was to sort of try to solve what is effectively a collective action problem, to use another economic term. So self-regulation can work, I think, when you have a very concentrated banking system, as you did in the United States until, I don't know when. I mean, don't we still have way too many banks?
3,600 banks, I think is the right number. 3,600 banks.
That's a lot smaller than it used to be. right?
Well, we lost, no, we lost in 08 to 11,
Wash Mutual.
1,200, 1,300 banks. We lost 450 banks in 6 months in 08.
But I think we still have a lot of banks per capita compared to many other countries, right?
Well, and if you talk to, one of my best friends in life is a guy by the name of Gene Ludwig. And Gene was controller of the currency. And Gene said, if you really wanted to make the banking system work, we'd have 5 banks. And you could figure out how to regulate 5 banks, you have a lot more flexibility, but Congress will never permit it because it is the local bankers who basically ensure that members of Congress get reelected. I mean, they pull people together, they do it in the rest of it, but you can't, regulating 3,600 banks is a big deal. And you have to admire the public service aspects of what the regulators do. Sylvia is 100% right. They have 1,500 regulations they're responsible for overseeing, and Congress continues to pass new ones.
They're very backward looking. There's this old expression, generals fight with the tactics of the last war. And so what's interesting about bank failures historically, we had the savings and loan crisis where that was a bunch of bad commercial real estate, a bunch of bad loans. Then we had the 08 crisis, which was a bunch of mismarked illiquid assets. And if you flash forward and said, we're gonna have the 16th biggest bank in the country fail, and they're gonna have a pristine, zero credit risk, highly liquid portfolio, that's what's gonna take them down. You kind of scratch your head and say the only way that could happen is if they went out really long on the curve and didn't hedge it.
So it's really interesting. So we were talking earlier today, if you take a look at kind of the bank and the shape of the yield curve, go back to the shape of the yield curve thing again, and you try to figure out what they were doing. And you got to remember, for 10 years, the interest rate cost in the country, actual interest, was 0, right? And so where are these guys playing? They're playing, look, we've got $75 billion of excess cash. If we play not here, right on the yield curve where you're going to get 0.5%, but if we play out here, we can get 3%. You get 250 basis points on $75 billion, and all of a sudden you're a lot smarter. The problem is, with all the warnings they had with the Federal Reserve telling you a year ahead of time they're going to raise interest. The management of the company in 10 years hadn't seen anything like true interest rates. I think they just simply didn't know how to react. I looked at it and said, we're making more money than we've ever made. Life is good. We have all of the balances that we could possibly have. What could go wrong?
And they had cash coming in hand over fist.
Hand over fist, and didn't know what to do with it.
So we've got time for a couple more questions. I'm gonna mix it up a little because again, so as you sit here today, there's a lot of different talk in the market about different residences. There's discussion of residential, the home price has been great, but now you've got mortgage rates, you've got commercial real estate. Maybe we're still not through the worst of.
When was the last time we had a major default in commercial real estate?
A building in downtown Boston?
No, I mean, no.
It was what I was gonna say in the, when I first came to Boston, like the 90, 91, 92, 93 era.
25 years ago.
Yeah.
I'm telling you, there's nobody running the banks today that have seen failures in commercial real estate. So they are astounded that the commercial real estate books might be in trouble. And you've got a lot more regulation, a lot more care about how that's done and what's being done with it, and all of that sort of stuff. But if in fact, the problem with commercial real estate that's going on today is exactly the same problem with the bond portfolio, which is it's simple. So the valuation of real estate is simply discounted cash flows. right? I mean, it's not a terribly, I mean, I was really good at it because it was really damn simple. It was just a really simple business to understand. You had to understand what was coming in, what was going out, what was left over, and how did you value that in terms of discount and your end capitalization of what's going on with it. Well, you know, these guys had been buying and working with stuff and the rest of it where their discount rate was maybe 3% and their terminal cap rate was 6%. And those things have doubled, right? So what happens when your interest rate doubles to the value? Anybody? The value? Anybody?
Will spent a summer in risk management. Interest rate doubles and your cap rate doubles. What does the value of your asset do?
Goes down.
By how much?
The interest rate went up 50%,
No, 100%.
50%. Then your value goes down 50%.
Go time. So all of this stuff they put on the books, very good. All this stuff they put on the books is worth half of what it was worth when they put it on the books. There is a crisis coming in commercial real estate, not necessarily the stuff we've seen and everybody's talking about, because people may go to work or they may not go to work, they may occupy offices or not occupy. Just simple arithmetic of what your discount and cap rate are is going to dictate that the buildings are worth 50 to 70% they were when you originally underwrote.
And
There is
without taking the negative with the reduction in potential cash flows.
Correct. And before that.
Yeah.
Right. And so what was the number? I think it was, I'm trying to remember the number. 800 billion, close to $1 trillion worth of stuff in the commercial mortgage-backed securities market. And that stuff is all going to have to be re-underwritten over the next 3 to 5 years. And if interest rates don't come down markedly, you're going to have a real interesting problem.
So you're optimistic about real estate prices. How about
That's commercial real estate,
Yeah.
residential real estate. The guys at Harvard, the Harvard residential, they've got a residential studies program, which is, they're just brilliant. I mean, they're just really interesting. They say that we are now 7 million housing units short in the United States to house the existing population. And we've stopped building new houses. And anybody can do, what is it, ISLM curves, right? Move it up, and can you restrict the supply? What happens to the price? The price is going to continue to go up unless the Fed continues to do something to try to collapse the housing market. And they're trying everything they can think of to collapse the housing market, but supply is so short and demand is really strong because the 40-year-olds who lived at home way too long, having two 40-year-olds, lived at home way too long, are now getting out there looking for houses because they've got families and rest, and they want to be, independent. And there's nothing they can do but buy existing houses to meet that demand.
And you've got the inverse of the Silicon Valley Bank problem. So Silicon Valley Bank locked in a lot of low coupons on investments. There's a lot of homeowners who have very low mortgages. And as you go think about trading up, you've got your cost of financing. You win when you have a mortgage at 4%, that you owe the money, but you're feeling pretty good about 4% versus the prevailing rate right now at 7.5%. So that's just created a very strange imbalance on people who want to sell their home and getting reinvested. Now, Sylvia, how about any kind of risk discussions you want to throw? We hit some two big ones, so I don't know if there's a lot of material left.
I kind of wanted to turn the question to some career advice for all of these young people. So, risk is here to stay, and it's gotten more complex. Real estate, it has been very popular with our finance majors for a long time. I think partly because interest rates have been so low and it's been such a boom area. So I'm not sure I'm very optimistic about folks that want to go into real estate. I think there's going to be a lot of really interesting work to do with workouts, but I'm not sure that we're going to be hiring new people to do those workouts. But I'm curious, Tom, in what areas of risk would you encourage these young people to be thinking about? And the finance job market, not to scare anybody, has not been easy for our undergraduate grads in the last 18 months, I would say, and I don't think it's going to get any easier. So you know, thinking a little bit more creatively beyond the traditional paths. is gonna be helpful.
So risk, risk is the translation of real life activities, right? Buying and selling houses, mortgages, into arithmetic. And understanding the bounds of arithmetic, and it's not hugely sophisticated arithmetic. I mean, my God, it's like when interest rates go up, bond prices go down. Kind of stuff. I mean, that's not that hard. And finding, or it's taking that view of what's going on in the world by having enough thought process around activities and translating those activities into a set of human interactions. So the clearest point of risk management is when you have to represent the financial institution in the community by going out and seeing customers and helping them work through their problems. And so the workout division at the banks where I worked always reported to me. At Fleet, the workout groups stayed in the commercial real estate group. At SunTrust, I would let the people in the businesses solve their own problems. But I needed 200 people to be able to do valuations, and they could go out and talk to folks and say, you got a problem. Your problem will rapidly become my problem. What do we do about solving that problem together? So, I mean, do you need to work within the risk management hierarchy? Lots of math, lots of chart doing, lots of taking what's going on in the world and translating into pictures which are relatively simple, so you can go to the board and present something within 15 minutes, which is actually a very complex problem. And that your presentations are designed to force the board to ask you questions. So they would get answers they might not come to by themselves, and left to their own devices might not go to the right area. So you built all these little traps in all your charts and stuff to make sure that they ask you the right. So presentation skills, but you know, I got into risk management because I was really good at solving problems, not because I was really good at math. I could find people really good.
Pretty articulate talking about risk. So we've got another minute or two. I'm gonna go to parting shots. So you've got a group of 18 to 22-year-olds in here. Some economics majors, some finance majors. Quick show of hands, by the way. If you're a freshman, raise your hand. Sophomore, junior, and senior. Then we've got a cross section. So real fast, Tom, if the two pieces of advice you'd have for people, then I'll go to the dean, and then we'll wrap it up, because people are very impatient.
I would say, if you're interested in the financial services industry, find a job. Don't find the perfect job. Don't play for. My business partner, I built houses on the side. My business partner's son may be one of the smartest young men I've ever met, but has zero interpersonal skills. And trying to find him a job to apply his applied mathematics stuff, and the rest of it is great, but he pisses everybody off so badly after about 90 days that we're not sure where you can get him, that you can isolate him enough from having.
I hope he's not watching tonight.
Yeah. It is, so find a job and understand a job is your job is not only to do what people ask you to do, but to anticipate needs, requirements, and activities and go out and do it. My first job in banking, I made $17,000 a year at Citibank in their training programs. I was married. Joanne was, had stopped her college education to get me through grad school. So she was going back, she went to NYU, which even back then was a very expensive school. But at $17,000 a year, we couldn't make ends meet. We figured it out. And then 10 years later, I had found a home, I had found things I knew how to do, and I had provided value to the institution, and the institution recognized that. And the important thing was getting the job, getting into some sort of a program where people would take an interest. Talk, interview, make sure you talk to all of your mom and dad's friends. Make sure any line of connectivity that you can possibly exploit. But when you get a job, right, and some of you will get multiple, right? Take the job and then figure out you've got 3 years where it's going to be very unpleasant because they're going to try and work you.
Party shot, Sylvia?
Just on
D&D
career
Maxfield.
advice, our alumni network gets incredibly high marks for supporting our students in their career discovery and in their networking. So, anybody who wants to hit me up on LinkedIn, I'll accept it. And then you go through my LinkedIn. And if you find people there that you'd like an introduction to, send me a list of those people, and I may not make the introduction, but I might. So, the alumni network is really a unique alumni network. Sometimes they'll call me up and say, fall senior called me and they want to get into investment banking. What are you doing? You're not letting them you're not educating these young people that you've got to start that, sophomore year at the latest. So we, thanks to Paul, are working very, very hard to make sure you are very, very prepared for when you have those conversations with alumni, but they'll engage with you 9 times out of 10. So use that network.
My party shot, and then I'm going to thank everybody. Always keep trying to get smarter and learn more about things. You've got a vignette now about Silicon Valley Bank. There'll be vignettes about IPOs. Always kind of keep learning, because that's what comes up when you're talking to alums, you're talking to things that will come up. I want to thank, we had people on Zoom, we actually had faculty, we had members of the administration. We had actually the president of the school here at one point in time.
The president and provost standing in the back.
And I would really like to thank Tom for coming, who has been a great supporter of the school. An award, and Team Maxfield has been very patient with putting up with the event and with me, and thank you both.